Welcome to the debate. Usually when we evaluate the health of a massive, dominant company, we tend to treat it like a colossal ocean liner, right?
Right, yeah, like if it's cutting through the water, generating record-breaking speed, and the engines sound fine from the top deck, we just assume it's unsinkable.
Exactly. The sheer momentum of it feels like a guarantee of safety.
It's a very comfortable way to look at things, honestly. I mean, we like to look at the massive top-line revenue, the sheer scale of the ship, and just assume that scale equals structural invincibility.
But the reality of modern mega cap tech companies is it's so much more complex than that. You can't just look at the top deck. You have to go down into the engine room. You have to look at the fluid dynamics of global regulations, consumer psychology, and, frankly, shifting geopolitical fault lines.
Absolutely.
So today, we're looking specifically at Apple. We're evaluating the structural integrity and the future resilience of their business model. But, and this is key, we're grounding this entirely in the empirical data, the risk factors, and the legal disclosures laid out in their 2025 Form 10-K.
Yeah, and the central question we're exploring today is arguably the most critical one for anyone analyzing the modern tech landscape right now. I mean, is Apple's deepening ecosystem and its massive growth in services robust enough to insulate it from these compounding global regulatory and supply chain headwinds? Or conversely, do these unprecedented legal and geopolitical challenges represent a true existential threat to its core margin structure?
Now, my position is that Apple's financial gravity, demonstrated specifically by its 14% growth in the highly profitable services sector, proves the structural soundness of its integrated model. I mean, it is fundamentally insulated from these external shocks.
And my position is that the coordinated global regulatory actions and the supply chain tariffs we are seeing, well, they directly target the very mechanics of Apple's high-margin profitability. They are masking critical vulnerabilities right behind those massive top-line revenue figures.
All right, so let's start by looking at the foundation of the argument. Because when you read through the 2025 annual report, the overarching narrative really is one of unshakable fundamental strength.
Well, unshakable is a strong word, but go on.
I mean, look at the numbers. We're talking about a company that generated $416.1 billion in total net sales for 2025. That is a 6% increase year over year.
Sure.
But the truly vital metric here, the engine that powers the modern iteration of this company, is the services segment. Services grew by 14% to an astonishing $109.1 billion.
It is a massive number. Absolutely. I mean, that's the headline that grabs everyone's attention, right?
It is, but it's the efficiency of that number that matters. That revenue is backed by an incredibly robust gross margin of 75.4%. Furthermore, Apple increased its research and development investment by 10% to $34.5 billion.
Right.
So my argument is that with this level of empirical financial strength, this level of pure cash generation and innovative capacity, the company possesses the resources to weather essentially any regulatory fine or market shift. The fundamental truth hidden in the data of the 10K is that consumer preference for an integrated, secure, private ecosystem is what drives these numbers. Therefore, the various legal challenges happening globally right now, they're just operational friction. They are speed bumps, not structural threats to the core business model.
Yeah, I come at it from a totally different way. Because when you actually dive into the risk factors and the legal proceedings sections of this 10K, which, are the parts of the document where management is legally obligated to outline what could break the company, it reveals an enterprise standing at a regulatory and geopolitical precipice.
A precipice? That feels a bit dramatic given the cash flow.
No. Look at the legal proceedings detailed here, specifically the Department of Justice's monopolization lawsuit, the European Union's Digital Markets Act investigations, and the Epic Games injunction. Those aren't just operational friction. They are surgical strikes aimed directly at the mechanics of that 75.4% margin services engine.
But a surgical strike implies they can actually dismantle the engine.
Which is exactly what the data suggest is beginning to happen. Look, relying on historical sales figures of $416 billion is looking at a trailing indicator. It tells you where the ship was yesterday, not where the icebergs are tomorrow. The forced unbundling of the App Store ecosystem, combined with the imposition of massive new U.S. tariffs on a highly concentrated Asian supply chain, it represents a fundamental, existential paradigm shift for Apple's cost structure. The profitability metrics we're looking at in 2025 are built entirely on a closed-loop system, a system that global regulators have now explicitly and legally ordered to be opened.
Okay, let's dig directly into that services engine, because that really is the crux of the debate here. The services segment, as we established, generated $109.1 billion. Now, if you're listening and wondering why I view this specific revenue stream as the ultimate shield against market volatility, it's because digital services operate on a completely different economic reality than physical hardware.
In terms of marginal cost, yes.
Exactly. Once Apple spends the money to develop the software infrastructure, the R&D, the marginal cost of distributing a digital service, an app, or an iCloud subscription is effectively zero. That is how you achieve a 75.4% gross margin.
But you have to ask how that 75% margin is actually maintained. I mean, it isn't just a product of zero marginal cost. It is the product of operating a toll booth where you are the only one allowed to collect the toll.
It's a highly secure toll booth that consumers prefer.
Maybe, but the 10K clearly outlines the very real immediate threat to this toll booth. Let's look at the California District Court finding from April 2025. The court found Apple in violation of the 2021 Epic Games injunction. And what does that mean mechanically? It legally forbids Apple from imposing commissions on outside purchases and stops them from restricting what's called steering.
Right. And just to clarify for everyone, steering is essentially the ability for an app developer to place a link inside their app that directs a user to a website outside the app to pay for a subscription, totally
Map to the cheaper option. And you have to pair that U.S. injunction with the European Commission's actions. The 10K notes a €500 million fine in their Article 5 investigation. What that specific article means in plain English is that the EU determined Apple was actively hiding cheaper alternative subscription options from users.
Well, they were restricting off-platform communication.
Right, hiding the cheaper options. And along with the fine came a cease and desist order requiring Apple to completely remove technical and commercial restrictions that prevent developers from steering users to alternative distribution channels. If developers can successfully and frictionlessly bypass Apple's payment architecture, which is exactly what the US and the EU are legally forcing Apple to allow, that 75.4% gross margin cannot physically be sustained. The causal link between the regulatory action and the collapse of the margin is direct.
Look, I see why you think that, but let me give you a different perspective, because I think we really need to talk about consumer psychology here. Operating the App Store is essentially like managing a five-star luxury hotel. Regulators in the EU and the US are essentially stepping into the lobby and saying, look, guests must be allowed to buy their room service from a restaurant down the street, and the hotel cannot stop them or hide the menus.
Which logically threatens the hotel's room service revenue, right?
Theoretically, yes. But you have to ask why the guests are staying at the hotel in the first place. Consumers stay at the luxury hotel for the curated, secure, seamlessly integrated experience. Even if you slip a flyer under the door for the restaurant down the street, the vast majority of guests are still going to pick up the phone and order from the hotel.
Really?
Yes, because the friction is zero. The payment information is already on file. It's authenticated with a quick glance at Face ID. The quality is guaranteed, and there's no cognitive load. I mean, the empirical evidence supports this behavioral psychology. Look at the 10K. Despite these ongoing legal battles dominating the news cycle for years, despite the Epic lawsuit being highly public, services revenue still grew by 14% in 2025. To me, that proves that consumers willingly choose the native ecosystem for its security and simplicity. They are not trapped. They are actively choosing to stay.
That's a compelling argument, sure, but have you considered the behavioral shift that occurs when the restaurant down the street is offering a massive discount? We aren't talking about saving pennies here. When major players like Spotify or Netflix can offer a 30% discount directly to the consumer because they no longer have to pay the hotel's exorbitant fee, the cognitive load of entering a credit card once on a website suddenly becomes very worth it to a family trying to manage their monthly subscriptions.
But Apple is still maintaining incredible retention.
Because the friction you mentioned was artificially enforced, and that enforcement is now illegal. Furthermore, the 10K specifically states that the Digital Markets Act, the DMA in Europe, provides for significant fines, up to 10% of worldwide net sales for non-compliance. We are talking tens of billions of dollars in potential fines if the EU decides Apple is still putting up artificial roadblocks to maintain that frictionless advantage. The 10K explicitly warns that changes to business practices to comply with these laws can adversely affect the experience for users and result in harm to the company's reputation. So if the seamless experience breaks down because of compliance mandates, that consumer inertia you're relying on, it begins to dissolve.
Okay, that is an interesting point, though I would frame it differently. Even if we assume, a modest margin compression in services due to this regulatory unbundling, we have to look at the secondary engine that must absorb that shock, which is the hardware division. And the hardware business is performing exceptionally well. iPhone sales grew 4% to $209.5 billion, driven specifically by consumers opting for the higher-priced Pro models. Mac sales grew by a massive 12% to $33.7 billion. Overall products gross margin actually increased to 36.8%. So even if the services toll booth takes a slight hit, the vehicle sales themselves are accelerating.
Yeah, but the report notes that the product margin increased due to favorable component costs and a different mix of products. That is past performance. It doesn't guarantee future cost stability.
It is a demonstration of systemic capability, though. Apple is arguably the greatest master of supply chain logistics in human history. To insulate themselves from the very shocks you are talking about, the 10K reveals they have secured $56.2 billion in manufacturing purchase obligations. If you're wondering what that means, it means Apple is actively locking in the global supply chain. They are buying up advanced manufacturing capacity, factory time, and specialized machinery months or even years in advance.
Right.
This scale creates a physical moat that competitors simply cannot cross. It guarantees product availability for Apple while starving competitors of parts, and it stabilizes their margins against inflation.
Look, I'm sorry, but I just don't buy that specific moat holds up against the current reality. Let me tell you why manufacturing purchase obligations cannot stop geopolitical trade wars. A contract with a supplier to use their CNC machines in Asia does absolutely nothing to negate a tariff imposed at the port of entry in Los Angeles. The 10K's risk factors are blaring a siren on this exact point. Apple admits that a significant majority of its manufacturing is performed by outsourcing partners located primarily in China mainland, Taiwan, Vietnam, India, Japan, and South Korea.
Which represents a highly optimized, efficient global manufacturing base.
It is optimized for a free trade era that the 10K explicitly suggests is rapidly ending. The document cites new U.S. tariffs announced in the second quarter of 2025 on imports from those exact nations. It also cites the U.S. Department of Commerce's ongoing Section 232 investigation.
Yeah.
For context, a Section 232 investigation is the U.S. government looking at whether importing certain items, in this case semiconductors, is a threat to national security, which allows them to bypass normal trade rules and slap massive punitive tariffs on those imports. The mechanics of a tariff are unforgiving. If a 25% retaliatory tariff is slapped on the semiconductor brains of an iPhone coming from an assembly plant in Asia, that acts as a direct, unmitigated increase to the cost of goods sold. Retaliatory tariffs have the power to instantly erase that 36.8% product margin because Apple cannot easily pass a sudden 25% price increase onto the consumer without completely destroying product demand.
Okay, I hear you, but I'm just not convinced by that line of reasoning. Because it assumes Apple lacks pricing power and strategic agility. Yes, the 10K lists tariffs as a risk because, it legally has to list every conceivable risk. But it also shows that Apple has continually navigated these exact geopolitical tensions for the last decade.
Have they navigated tariffs of this magnitude, though?
Yes, they have a demonstrated ability to shift production. They've moved massive amounts of assembly to places like India and are expanding in the U.S. They are diversifying their manufacturing footprint precisely to mitigate these localized tariff impacts.
But shifting a supply chain of this magnitude requires considerable time and resources. You are dealing with physics and chemistry here, not just logistics. The 10K itself states that new products often utilize custom components available from only one source in the world. You cannot simply pick up a custom silicon fabrication plant in Taiwan, put it on a boat, and drop it in Texas overnight.
Nobody is suggesting overnight.
But the exposure to sudden trade restrictions is acute. And when you combine those supply chain tariffs on the manufacturing side with localized regulatory enforcement on the sales side, you get a fragmented global market that threatens the very core of Apple's geographic performance.
Well, look, if we are going to look at the global market, we have to look at the actual geographic performance numbers, because the data in the 10K actually contradicts the idea that international markets are broadly turning hostile to Apple.
I would argue the data proves exactly that. Look at Greater China, which historically has been one of Apple's absolute most critical growth engines. Net sales there declined by 4%, dropping from $66.9 billion down to $64.3 billion. This is a direct reflection of local market conditions, geopolitical sentiment, and fierce domestic competition finally taking real market share.
China is one market.
But the fragmentation isn't just in Asia. Look at Europe. The European Court of Justice confirmed a €10.2 billion state aid decision for Ireland. This means the EU effectively ruled that Apple's decades-long strategy of routing European profits through Ireland to minimize taxes was illegal, and they clawed back €10 billion. The era of utilizing favorable global tax structures to maximize net income is fundamentally over. If you are facing shrinking consumer revenues in China and massive retroactive tax clawbacks in Europe, your bottom-line net income is under siege from multiple geographic fronts simultaneously.
Okay, yes, a €10.2 billion Irish tax hit is a staggering number. No one is denying that. But we have to contextualize it mechanically within the financial statements. The 10K shows this was a one-time charge, fully accounted for in the fourth quarter of 2024. It is a settled historical event. It is not a recurring operational expense that bleeds them dry every year.
It's still capital out the door.
Yes, but even after absorbing that massive historic charge, look at the balance sheet as of September 2025. The company maintains $132.4 billion in cash and marketable securities. I mean, they literally have the liquidity of a mid-sized sovereign nation.
Cash reserves are buffer, sure, they protect you from bankruptcy, but they do not protect your margins from structural decay. A dying company can still have a big bank account while the house burns down around them.
But the house isn't burning down. The business model itself is showing incredible geographic resilience to offset the China decline. Yes, Greater China was down 4%, but look at the offsetting growth. Europe, despite the regulatory environment you mentioned and the tax hit, grew by 10% to $111 billion. The rest of Asia-Pacific segment grew by 10% to $33.6 billion. Japan grew by an incredible 15%. This geographic diversification is the ultimate proof that the integrated business model can absorb regional downturns. If the Chinese market softens because of domestic competition, the massive surge in Japan and broader Asia-Pacific steps in to carry the load.
But, see, I come at it from a different way. The growth in Japan and Europe is impressive on the top line, absolutely. But we have to return to the margin structure to understand the real vulnerability here. If the European growth of 10% is being achieved while simultaneously the EU is legally forcing the unbundling of the App Store via the Digital Markets Act, the fundamental profitability of that European revenue is changing.
In what way?
You are trading high-margin, closed ecosystem revenue for lower-margin, open market revenue. The money coming in from Europe today is simply less profitable than the money that came in from Europe 3 years ago.
I completely disagree that it necessarily becomes lower margin just because the ecosystem opens slightly. The 10K clearly outlines that Apple has implemented new business terms and alternative fee structures for iOS apps in the EU to comply with the DMA. They are not simply giving the infrastructure away for free. They've created new frameworks like the core technology fee. They are adapting the monetization strategy, not abandoning it. The core underlying value, which is the hardware excellence, the seamless synchronization between the Mac, the iPad, and the iPhone, it remains entirely intact. Consumers are still paying a premium for the hardware, and as we discussed, the hardware margins actually expanded this year.
Expanded, yes, but under the looming shadow of the Section 232 semiconductor investigation and retaliatory tariffs, we cannot look at these risks in isolation. You have to synthesize them.
The Department of Justice lawsuit targets the hardware ecosystem lock-in. The DMA and Epic lawsuits target the services margin. The U.S. tariffs target the manufacturing cost structure. When you read the risk factors section of the 2025 10K as a cohesive narrative, it paints a picture of a company facing a synchronized, multi-front assault on the exact mechanisms that allow it to extract outsized profits from its global user base.
Well, let's summarize our positions as we look at the totality of this data. From my perspective, the 2025 10K validates the profound structural integrity of Apple's business. Yes, the legal and geopolitical headwinds are very real, but Apple's unparalleled $34.5 billion R&D investment, its diverse geographic revenue growth completely offsetting the slowdown in China, and its massive $132.4 billion liquidity moat, they provide an insurmountable defense. Regulations like the DMA and rulings like the Epic Games injunction will certainly force an evolution of the digital ecosystem, but they will not cause its destruction. The 14% growth in services proves that, at the end of the day, consumers fundamentally desire the curated, low-friction, secure experience that Apple provides.
And my summary is that we must separate top-line momentum from structural vulnerability. Just because the ship is moving fast doesn't mean it isn't taking on water. The 10K definitively shows that the core pillars of Apple's legendary profitability, the strictly controlled 75.4% margin App Store system, and the highly optimized, hyper-efficient Asian supply chain are facing unprecedented dismantlement. Between the DOJ monopolization suit, the EU's unbundling mandates, the Epic steering injunction, and the new tariff regimes threatening hardware margins, the fundamental mechanics of how Apple makes money are being forcibly altered.
I think where we absolutely find a point of convergence is on the reality of the digital storefront itself. The legal landscape, particularly the enforcement of the Digital Markets Act in the EU and the finality of the Epic Games injunction in the U.S. District Court, ensures that the way Apple operates its software economy will be permanently altered moving forward. The closed-loop system is mathematically and legally opening up, and there is no going back from that.
Yeah, we are in complete agreement there. The days of a single, unquestioned payment gateway on iOS are over. And I think the financial ramifications of that shift, particularly how consumers behave when presented with genuinely cheaper options outside the ecosystem, well, that will take years to fully materialize in the earnings reports.
Which brings us right back to where we started. When you are evaluating the structural architecture of a global technology giant, you really have to look beyond the shiny exterior of top-line revenue. You have to look at how the machinery actually operates under stress to understand the intricate load-bearing vulnerabilities beneath it all. We highly recommend that anyone analyzing this space go read the specific legal proceedings and risk factors sections of the 2025 10K for themselves. Look at how these mechanisms function and form your own judgment on whether these stress fractures are just superficial scratches on the hull or foundational cracks in the framework.
The blueprints are all right there in the filings. You just have to know where to look.